You're listening to the Multifamily Mentor Show.
My name is Terrence Doyle.
And I'm Chris Lopez. You probably know us from the BiggerPockets Real Estate Ride Along Show. Well, now we're talking everything multifamily. We bring in top industry experts from around the country to come join us in our Denver studio for an in-depth, in-person conversation.
We're going to be diving deep into deals, underwriting, raising capital, and everything in between. Join the conversation.
What's up, BiggerPockets? Welcome back to the Multifamily's Mentor Show. This is an impromptu recording that happened in the last 36 hours, and now we have an amazing guest who just landed in Denver, and we're going to record an amazing podcast, two actually today. Terrence, what's up, and who do we have?
Chris Lopez, what's going on? Man, I'm super excited. I'm just calling it right now. We've had some amazing guests in season 2. Incredible. We've had some awesome people. I think this is going to be the best episode of season 2. I'm just calling it right now.
That's a bold prediction.
I'm calling it right now. We got Gino Barbaro in the studio, just flew in from Florida. He's got an entourage. His entire family's here. His mother-in-law's here. I mean, he brought the energy, brought the love, and we're excited. So Gino, welcome to Multifamily Mentors.
Gentlemen, it's a pleasure to be here. Thank you. Thanks for having us.
And this just in, his wife, Julia, was telling us, this is Gino's first, I mean, you've done hundreds and hundreds of podcasts. The first one live in a studio in person.
Yes.
Right?
Yes. And little teaser here. Superpower. We're going to talk about it, but my superpower is sitting there right now, right in the studio. So that's going to be an interesting conversation, Terrence, isn't it?
Yeah. So that's going to come a little bit later, but yeah, that was an amazing moment we just shared, and yeah, I'm just so excited that you're here. So a little background. Let's back it up. So if we go 6 days ago, we didn't even know each other. This is Friday. 7 days ago, you and I didn't know each other. Last Friday, right? I'm landing in Tampa. Shout out to David Tupin, Real Estate Lab Conference, right? We didn't know each other. I was one of the speakers Saturday morning, and I speak. You ask a great question to me. You asked me a great question in the audience, and really got my mind thinking about acquisition fees and how to hold things longer and how to align interest. We'll talk about that later. And then you and I have a great interaction afterwards. We record some content, and I wanted to pick your brain about public speaking. Right, because you've done a lot of public speaking. You talked about having a mentor and a coach, and I was like, "Hey, Gino, would you mind sharing some of your information? I want to get more polished and work on that." Mm-hmm. And most people, you meet them and they're like, "Yeah, I'll email you. I'll email you in a week or a month later." You emailed me at 5:30 a.m. the next day. You're like, "Terrence, here are the things that have helped me." Right, and then the email goes back and forth, and I'm like, "Hey, Gino, if you're ever in Denver, I'd love to have you on the show. We tried a year ago. We'd love to have you on the show." And you're like, "Hey, I'm actually going to be in Denver with my family this Friday." And here we are. I mean, that is amazing, right?
You can either make an excuse or you can make it happen. And the great thing about it was Saturday at David Tupin's, an amazing event, and everyone needs to go to these events, right? I mean, that's where you get the energy, that's where you get the education,
right? That's
where you get the networking. And I would have emailed you Saturday night, but we went to Disney after. So you got to play. Right. The whole family was there. Bring the whole family, right?
Right.
That's what the important thing for me is business. So getting clear on what your business is. My lifestyle is surrounded by my business, whereas we're going to talk about what my previous life was. So for me, it was important. And getting out of that event, young entrepreneurs. Mm-hmm. It was an amazing event, wasn't it? And I heard you speak. I loved your story. It really resonated with me, the mistakes that you made, the mistakes that we all made, but you persevered. Mm-hmm. You didn't crawl up into a fetal position, go into the corner. You persevered. That's right. And you learned a lot from it. And you got on stage, you're vulnerable, you shared your story. And I love that about you because it feels as if I was listening to myself.
Yeah. I think the Colombian Italian blood, we were really bonding over that. So let's take it back though. I think it's really interesting, your background in hospitality. That you were a restaurant owner, small business owner in New York. Thankfully, it wasn't during COVID, right? Thankfully, you got out of it before that. But small business owner, hospitality, I think, besides property management, one of the most difficult industries to be in, right? So you're battling. So talk about, there's a lot of people listening that own a small business and they're struggling. And they're like, how do I get freedom? How do I get more margin in my life, right? And you've done it. Right? You're looking back 10 years later, 15 years later, and look at you're traveling with your whole family, you're like living an amazing lifestyle. So take us back to what that was like. What was the genesis of getting into multifamily and transitioning from such a difficult industry?
Do you mind if I start back from when I started the restaurant? It was 1994, May 17th. That was D-Day for me. I'll never forget it. A long time ago, I had just gotten out of college and my father owned a restaurant and that's what I wanted to do. I thought that's what the entrepreneurial journey was. And, 25, 30 years ago, life was different. There was no internet. Margins were better. There was less competition. For the first 10 or 15 years, it was wonderful. I loved it. 2007 comes, my dad passes away. And I said to myself, am I living my dad's dream or am I living my dream? I didn't know because I had gotten into it because it was just a family business. And at that point, I didn't feel like I was living my core values. I didn't know what core values were at the time, but I just didn't feel as if I was living my dream and my passion because I wanted to create a business. I wanted to create something scalable, and I only had one restaurant. 2008 comes, I get into personal development, start listening to T. Harv Eker and all of these different, Jim Rohn, Tony Robbins, Mark Victor Hansen, all of them. I start reading it and I say to myself, there's got to be something better. And I'm finally taking responsibility for my actions. Meet Jake in 2009. 2011, he moves to Knoxville. I'm like, you're leaving already? But when he goes to Knoxville, I pull out the laptop and I'm looking at these deals, 30 a door, 35 a door. This makes sense. It takes us 18 months to find that first deal. And we'll talk about mentorship later, but I did coach with a lot of different groups that really helped my trajectory. I'd made a bunch of mistakes before. We bought our first deal in 2013 and the rest is history.
So you jumped over a lot of things there. First of all, because I'm getting ready for lunch here. So what kind of restaurant was it in New York?
Pizza. 75 seats. It was amazing food. The food's amazing. But
brick oven or what do we?
No, actually gas oven. But man, let me tell you, it was good, really good.
Great pies?
Yes, excellent. My dad learned on a coal oven, so in Brooklyn. So
Dave Portnoy would have come by there and given you a really high rating.
Oh,
a
absolutely.
Pizza review.
In
the eights?
Yeah. Jewel, 8, 9.
Would he have liked that?
I would say 8.5.
Was he into the pie?
I would say
he would have been into it.
8.5. Yeah.
All right, great. So it was a pizzeria, right? And you're there, and you had one location. And you wanted to scale that, so you got multiple locations, or what happened after that?
So what ended up happening was we wanted to do multifaceted. At the time, I'm thinking, let's maybe write a cookbook. So I wrote a cookbook.
Wow.
I started doing physical products. I started going into my garden, doing gardening videos. Because what my whole vision was to get the family around the table and teach families how to cook.
Right.
But I had a brother. My brother was a partner, and it took a couple of years to get that going. And as I got it going, I meet Jake, and I'm like, this multifamily thing is more scalable. It's easier.
So Jake had the idea for multifamily. He was the one that was like, hey, Gino, let's do this.
He was pushing me. Yeah,
he
was sort of pushing me because I was out of my comfort zone. Because I'm like, how do I scale this? How do I go out of my market? How do I do all of this? Because remember, he moves to Knoxville, and I'm in New York. So I'm like, I've got to do this from afar. So
partnership. Chris and I have been talking about partnership, right? We've known each other for 4 years. We're just now becoming partners in the media company, right? Just now, 4 years. It took us 4 years to get to a place where man, we want to do business together. We've had a good track record, built some good momentum. I see how he works. I see how he treats people. I see his values. It's like, man, this is a guy I want to go to war with, right? What's your view on partnerships and how long you knew Jake? And what are the steps that you took to be like, hey, this is a guy, because you guys have built an amazing brand, company, all these things. What was that process like for you?
So I listened to you this weekend and you were talking about raising capital. And when you raise capital, you get to know the person intimate. You let them come and fly into your office and you meet them. So when you're looking for a partner, your values have to align. Your core values have to align. Is it long-term mindset? Are we doing multifamily, or are we going to get this shiny object? One day it's single family, one day it's multifamily. Jake was a pharmaceutical rep, so he'd come into the office every day, and I'd know what doctor's offices we'd have food delivered to. So he was really prepared, hard worker, coachable, long-term mindset. All of these things aligned with my values and my goals. So for me, it was an easy fit, and we did our first deal together. If it didn't work, no harm, no foul. But after the way I saw that he worked and how we worked well together, I'm like, let's take a chance at it. Every deal has its own LLC. If at some point it doesn't work anymore, we can just walk away from it. But just that small step.
How long were you observing that? How long was he coming into your pizzeria? How were you observing him and watching that? What was that process?
I would say 18 months. I mean, from 2009, I met him, and in 2011, when he moves down, I'm like, okay, it's about 2 years. So I've already known him. He's been consistent, right? He has that long-termism, even though he doesn't know it, but he's really prepared, and he was a hard worker. That's what I love about people. If you're a hard worker and you're prepared, you can do anything.
Chris, you've been in partnerships. You've had partnerships go well, go bad. I mean, talk about how long you're in your experience, the audience, everyone's like, they reach out, hey, how do I find a capital partner? How do I find an operating partner? Like everyone, especially the audience are young. They're like, how do I find partners? What's your take on partnership and maybe some of the pro tips that you would have?
Take your time. I'm almost 40. I'll be 40 this year. My first business partner was 21. Jumped to it very, very quickly. 2 partners. One was great. One was not great. So what I've learned from that is, hope for the best, but always plan for the worst. Partnerships are like marriage. I think 50% do well, 50% don't do well. And when you go into a partnership or marriage, you never think about divorcing one day. So what is that plan B, or what's that exit strategy to make sure, hey, if things don't work out well, how can we separate and not, I can't be ruined by this or vice versa. So I think having that realization that things don't always go well, you have to start at the end of mind, but hope for the best. But I go back to what you were saying earlier, Terrence. It just comes down to like core values. Like, is this someone that I can go to war with, that I trust with, and that If I'm not there, do I trust you at the helm of the ship while I'm gone? And so I think those core values is very important. The other thing besides the core values is there has to be complementary skill sets. If the three of us have the exact same skill sets, like we all have the exact three sets of strengths, it's not a great partnership. But, Terrence, you and I have a lot of things that complement each other.
Right.
Just like you and Jake do. Like my strengths should complement your strengths, and 1 + 1 = 3.
Can I add a couple things to that?
Of course.
First,
I'm taking notes.
I think everything you should understand is you need to take responsibility for the good partnerships and the bad partnerships. Because I've had some bad partnerships, and I've been responsible as well. I didn't vet my partner. I didn't do due diligence. So when you have a bad partnership in life coaching, we call it an energy block. It's called an assumption. When you have a bad partnership, I don't want anyone to assume that the next one's going to be bad, because that can really hold you back.
What do you mean by that?
So when you're in a relationship or you have a partnership, let's say it goes bad, you may have it in your DNA saying, well, I'm not going to take this risk because I've already had a bad one. And my first deal in 2005 was a mobile home park with a partner. Terrible deal. Terrible partner. But I didn't do due diligence. I didn't vet the deal. I was a bad partner just as much as he was. If I had had that relationship and that experience ingrained in my mind, I never would have taken a risk with Jake. So when you go back and you look at all of these things that you've done in life, learn from them. They're not problems. They become opportunities. And then when I went in with Jake, I went in 1 foot first. It took us that 18 months to find that first deal. I wanted to make sure that he was working hard, going to the brokers, doing the property tours, putting in those offers. And it took us a little while longer because maybe I was vetting him and taking a look at what he was ultimately doing. And he ended up working out really well.
I love that. So, I mean, hey, when something bad happens, there's emotional baggage. Yes. There's always is. But rather than just saying, hey, that's the way it is, you deal with it. But then you learn from it and say, great, partnerships are bad, X, Y, Z, and this didn't go well.
Yes.
Let's avoid that in the future, right?
Yes.
And failures, we were talking about this before the podcast, failures are the best mentors and education out there.
I agree.
What other tips do you have on partnerships? You said a couple thoughts.
Long-termism. You have to align. Your goals have to align. We have not deviated from multifamily. When people bring us other opportunities, whether it's crypto or whether it's something, we won't. Or it's single-family homes, we won't. I mean, we're getting into development now, but we're doing it because we're going to build multifamily housing. So it's really within our sphere of influence. And for us, as far as complementary, when you're going into a venture with a partner, think about a visionary and an integrator. We sort of go back and forth on both of those because we're both sort of visionaries, but we both can integrate as well. So make sure if you're going to a partnership that one of you is at least the visionary who's got the big, great vision of what the company's like, and the other one is the integrator who can do the day-to-day, who can do the daily grind. And it's really ironic. Not many people can have both, but we can go back and forth and do both of those skills. So make sure that at least one partner has one of those two skill sets.
That's such a great tip there.
It's so important. You just see, real estate, to do well at real estate, right? We've been in an inflationary period. Interest rates are going down, cap rates are getting compressed, so everyone's making money, right? So partnerships, even if they may be on the rocks, they're making money, so they're happy.
Yes.
But I think, we're headed for turbulence, right? And so what that's going to do is really test a lot of partnerships. And I think this is really valuable stuff to think about. Before you get into a partnership, it's like a marriage, like you guys both said, is ask difficult questions, right? Get in different environments, get your wives or girlfriends together and see what they think. I can't stress enough that patience is key. We live in this microwave society. Everyone wants to make money in 3 minutes, 3 hours, 3 days. It takes time. And to have a great partnership, I think you have to spend a lot of time with someone, and so I echo everything you guys are saying. I just think patience is what resonates with me.
Terrence, I think the other thing that we need to do in real estate is when you're with a partner, what's your exit strategy on every deal? Think about what the exit strategy is. For Jake and I, most of the stuff we buy, we hold long term, and we want to do that. If you've got a partner who wants to constantly keep flipping, but you want to hold long term and create wealth, your values, your goals don't align. So your goals need to align. And if they don't align, there's going to be constant friction. Am I selling the deal? Am I not selling the deal? Am I holding it? Am I not holding it? Am I buying it for cash flow? What is it? You have to have those aligned.
Yeah, I love it. So going back to your story, Jake moves to Knoxville. You guys spend 18 months. Chris and I were just talking about this. 18 months. Like sometimes when I was transitioning from single family to multifamily, it took me 12 to 14 months to get brokers to trust me.
Yes.
Right? To be like, hey, because it's hard for a broker. They get to see 4 or 5 home run deals a year. For them to send it to you, they have to really trust you and have confidence you're going to close, you're going to perform, what you're doing, right? So talk about maybe some of the perseverance, talk about what it was like to get that first deal, how you guys underwrote it, how you funded it. Walk the audience through like your first deal, new partnership, new market. What was that like?
It was scary. First deal.
Right.
You don't know what you're doing. Like I said, he went out and bought a house while at 18 months. So a lot of his capital dried up.
Wow.
His fiance at the time was living in New York, so she had to move down. But I knew what I wanted. I knew my why was getting out of the restaurant business ultimately. So I didn't stick with it, and I persevered. And for him, getting out of that sales job, he didn't want to work with Glaxo anymore. You know, healthcare got really impacted back in 2008 and 2009. So he's like, my paycheck's getting cut. I'm making just as much sales. My paycheck's getting cut. So for us, there were deals back then. Let's take a walk down memory lane in 2013. There was a lot of deals.
Little capital, a lot of deals.
But what didn't we have?
Right.
There was GDP was 1%.
Right.
Rents at this first property we bought were $350 a month for one bedroom.
What year was that?
Right now, 2013.
That's wild.
Right now, they're $900 a month.
3x.
So we've held, and sentiment's a lot different. There was no money. The way we funded it was a 10% down payment, 10% owner finance, and 80% bank. So we got owner financing on our first deal because we had a great broker who educated us, who showed us how to do it. And he was actually an awesome broker because he talked to the sellers. It was a mom and pop. Thing was hard to finance. It was weekly renters. So we saw the income. We were thrilled about the income, but you don't want a weekly renter property. Real big turnover.
Very difficult. It's like a hotel.
Hard.
It's like running a motel.
It was exactly, but that was the opportunity. That's what I knew at the time. It was 25 units, $600K. Now the property's worth over $2 million now. We've held it, and it's paying for all the kids' college over there. Yeah. Every month that cash flow, it's paying for all the kids' college, and it's a great deal. Would I buy that deal today? No, because I've gotten bigger. We're buying newer assets in this part of the market cycle, but I will hold that deal long term because it's paid off. Residents are paying down the debt. We've got great cost seg on it, and we've got great cash flow every month.
So I love that. I mean, I think it's amazing. You started out with a 25 unit. You know, so many people listening, they're like, I need to buy 100 unit, 200 unit. I mean, that's so much out. It's like, just buy value.
Yes.
Buy value. Buy a good asset. It doesn't matter how big it is. One of the things that I learned from you this weekend was, what's your profit per door? No, I haven't heard. I mean, we've done how many of these interviews? You've been on how many podcasts with me? No one has talked about what is your profit per door.
I've never heard that metric.
Yeah, profit per door, right? So maybe talk about profit per door. And I also want to hear you expand on, where did the mentality to hold long term? Because most people, especially on their first deal, they're looking to make a couple $100,000.
Yes.
So where'd the mentality come to hold long term, and talk about profit per door?
Wow. I could spend 30 minutes talking about
this. We have 10. So yeah, do your best. Condense it.
Profit per door. A lot of syndicators don't make money on the front end. They're looking to get acquisition fees. Hopefully they roll that money into the deal on the LP side. For us, we're a smaller company. We don't want to syndicate deals. We want to hold deals for the long term. So we're looking for our profit per unit. After all expenses are paid, last month it was around $300, $289. On average, we want at least $150 profit per unit. Now, certain markets that have higher rents are going to have more profit per door, but you're going to be able to buy less doors. So it all really works itself out. For me, it's a metric. I want to have that profit per unit. That's what we're looking for in that profit. That's one of our KPIs, or key performance indicators. Other one is delinquency. We look at delinquency, vacant rented, vacant unrented. We're looking at applications. There's a lot of different metrics. So this profit per unit hits the bottom line. Really, really important. And what was the other question you asked me?
Was, the wealth mentality of holding long term, right? People, again, going back to like this microwave society, they want to turn something, make a couple bucks. Talk about building wealth.
Yeah.
And where does that come from? Holding. Like your first deal, why did you want to hold? In 2015, 16, you could probably double your money. Where did that come from? Did your family, was it Jake? Talk about holding long term.
It was maybe misguided in the beginning, because what I wanted to do is to have a couple hundred units, getting $10,000, $15,000, $20,000 a month in cash flow, become financially free. Once I had that little nest egg, I can go out and buy bigger deals and syndicate other deals or start other businesses. So that was my genesis. I just wanted to get cash flow every single month. And then you know what? Once it started working and we started refining these deals and we started repurposing the money into another asset, I'm like, I have this deal with no money of my own in it. I pulled the money out and it's still cash flowing. Why would I want to sell it? Mm-hmm. And with cost segregation, I mean, when you have a negative adjusted gross income, you have all those write-offs. It's so worth it, and you keep buying, and the cost seg party continues. And it's a very hard thing to do. Like you said, that instant gratification is what I'm teaching my children. It's one of the most difficult things to get over, because you sell a property, you have $300,000. Or you can get $10,000 a month for the next 10 or 15 years. You're deferring it and you're living a lifestyle. I'd rather hold stuff and hold for the long term. That's what I want to do. My parents are immigrants. Immigrants are taught to save. Saving is very, very important. Unfortunately, as middle-class people, we're taught to save for an event, save for college, save for retirement.
Wedding, yeah.
As an entrepreneur, as the wealthy, you need to save for an asset.
For opportunity.
Because that asset will pay for the event. Like I said, that very first deal When I saw my daughter go through college, she did 4 years of college. That asset paid for her college. Now my son's a sophomore. That asset's paying for him. The next 4 are going to go with that asset. When they're done with college in 10 or 15 years, I'll still have that asset. There'll be no debt on that asset, and they'll still keep cash flowing.
I love that analogy in the phrase "save for the asset."
Mm-hmm.
Like it's so simple. I mean, I've learned that, but just the way you said it, that is a great quote to go by. So when you say hold for the long term, does that mean just hold until you die, or like what's long term to you, or is
Great
it who knows
question.
that far?
For us, I'm putting a lot of stuff in trust right now for my children because I don't want to have the fire sale, but it depends on the asset itself. If the asset really runs up and I can find something else to repurpose the equity in, we will do that. We sold a few small deals to get into other deals. Depending on the market cycle, right now we're looking at assets that are a little bit newer in this part of the cycle. Depends upon the area also. If the area all of a sudden median income drops or we just don't like the area itself, we will sell that asset. But for us right now, we're vertically integrated. We have a property management company. So we're running these assets and we're building our team out. So we're responsible with 300 to 400 assets, units a year we can add on. That's what we're looking to do. And just buy really, really good assets. Like I said, with the profit per door. That's what we're looking for these deals.
When you say, one of the nuances here, I think is a pro tip, but expand on when you say in this part of the cycle, we're looking to buy newer assets.
Sure.
Expand on that, explain that.
Mm-hmm.
Let's go deep in that.
Yeah. So what we've come up with a saying, one of our coaches, we trademarked it. We call it the 3 pillars of real estate. The information is all out there. The 3 pillars are market cycle, their debt, and their exit strategy. So in any part of the market cycle, back in 2013 and 14 and 15 and 16, you're buying older assets because the price per door is cheaper. You can rehab those, and as the market is accelerating, you're starting to sell those off. Now, where we're seeing this part of the market cycle, I'm sure in Denver as well, cap rates are really compressed between the B's and C's. So why would you go out and buy a C property when it practically costs as much the same to buy a B property? So in this part of the cycle, you're buying assets that are a little bit newer. You're buying assets that have a lot less CapEx requirements in them, and you're holding them long term. Now, as the market cycles back down and prices get cheaper and those cap rates expand a little bit more, C's get a little bit less expensive, and you can buy those kinds of deals. You just have to know the market cycle. And the exit strategy that I talked to you guys about, that exit strategy is so important because what kind of debt are you going to get on it? If you know you're going to sell this deal in 3 to 5 years, you're not going with yield maintenance or defeasance or a high prepayment penalty. So you have to really pivot at what you're doing. So if you can put all 3 of those together, know what kind of asset you're buying. We call it the buy right criteria. Like I said, that deal that I bought, that first deal, I'm not buying it now because it's too expensive. I'm not going to cash flow on it. And it's an old asset. And am I going to be able to hold this for the next 10 or 15 years without a lot of CapEx? Changing roofs, driveways, AC units. That's what we got to worry about in this part of the cycle. If you can buy it right, you buy it right. But it's hard in this part of the cycle.
That's phenomenal. Yeah. So we talk about that a lot is, cap rates are about the same. If you buy a value add deal in Denver right now, you're going to pay, it's about a 4 cap.
Yes.
But you can buy a brand new construction deal for like 3 3/4 cap.
Yes.
Right. So the cap rate's about the same, but the value add deal, you have to put a bunch of time and energy into. So I definitely see that. And it makes a lot of sense for people out there. You don't have to fall in love with this. People see the projects we're doing, a ton of construction. We basically, I'm boots, you look very buttoned up. You got a beautiful suit on. I'm wearing boots. I'm going to go from here to a construction site, right? So people see construction and they're like, oh, we want to do a value add deal. But identifying the market cycle and looking at the data and saying, hey, you know what? Maybe that's not the right move for me. Maybe I need to buy something a little newer, less CapEx, because risk adjusted, that's a better buy.
I love that.
So identifying the market cycle, I think is like an amazing point that no one else has talked about, right? Is maybe value add is the right strategy, but in 3 or 4 years when there's maybe a dip, and then that the cap rate, maybe you can buy a value add deal at a 5 cap, right? Instead of a 4 right now. And so I think that's an amazing pro tip that everyone really needs to think about is what's the right move for you in this time of the cycle? If your advantage is in construction, then you shouldn't be doing a value add deal. Go buy a newer deal and maybe pay 25 basis points more, right? So a little, the cap rate's a little more compressed, but less risk adjusted in this part of the market.
Do you mind if I just one more tip for the listeners out there? So when you're buying a deal, especially when you're brand new, I want everyone to think about the 3 pillars: the buy right, the manage right, and the finance right. But I want you to figure out what your buy right criteria is. Like you said, Terrence, you have skill, you have construction. I don't want a new investor to go out there and do an absolute heavy lift, 100-unit property in their first deal. Figure out what your buy right criteria is. Age of the asset, maybe cap rate. What's your pro forma cash on cash return? The submarket, brick, pitched roofs, what kind of amenities, washer, dryer. median income. Get really granular on what you're looking for. So when you do speak to a broker, it doesn't take you a year to talk to a broker. You can tell the broker, I'm looking for a 1980s build, B minus asset. I'm looking for 30 to 50 units. I'm looking for median income about $60,000. I'm looking for pitched roofs. I'm looking for brick. The broker will go, you know what? I have a deal like that. Or they'll say, you know what, I'll be on the lookout, and you'll sound professional and you look professional. So everyone, when they're out there, and these buy right criteria, they're constantly changing because the market is changing. You're going to change it. 5 years ago, washer dryer hookups were not a big deal. Now it's a huge amenity. So you've got to know what the pulse of the market is, and you have to be flexible, but you have to be certain. We talked about it at Dave's event this weekend. Focus. When you have that focus and you know what you're looking for, it's going to ultimately show up in your life.
Yeah, I mean, being able to communicate with brokers, just being realistic, being clear about your criteria. If you can't identify and clearly articulate to somebody what you're looking for, how is the broker going to know what to look for? They're based on commission. I talk about it all the time. Like, to align interest with a broker, you have to be able to clearly articulate what you're looking for and show them you have the ability to close. And then you'll get a broker excited and you'll start seeing a lot of deals. But if you can't, just step one, fundamental, if you can't say this is exactly define what you're looking for, you're never going to get it.
Yep.
You're never going to get it. So I love that.
I get these calls all the time. I do a lot of brokerage stuff, and people are like, oh, I want to invest, do this. I'm like, cool, what do you want? And it's 5 or 10 minutes.
I want a deal.
I'm like, well, what do you want? Well, I want a good deal. Well, okay, what's a good deal? Well, something's a good deal. No, I don't know what a good deal is for you. Like, I know what I want, but what the heck do you want? And if you can't get that clarity, when you hang up that phone, that person just...
It's a great point you made. What's a good deal for you? A good deal for you is not a good deal for you, and is not a good deal for me. We all have different goals. I'm a little bit older, right? I may want deals that cash flow a little bit more, that want a coupon clip. Someone who's younger may want to take a little bit more risk and may have the equity appreciation play. So the first thing, everyone out there, look at what your goals are. Look at what you're trying to accomplish. Do you have a W-2 job where you can only spend 10 hours a week, or are you bootstrapping it and you're in construction? You can spend all of your time looking at these deals. So like you said, the first step is to get clarity. And what are your goals? What are you trying to achieve with this investment?
And that's great. I mean, for example, like when I buy directly owned real estate, I like to buy more new stuff, more turnkey stuff, because I work a lot on a couple businesses, but I invest in Terrence's deal, who's amazing at value add stuff. I can't do what Terrence does, but I'm going to put the money in his deals because I want to do what he does.
Who, not how, right?
Yes.
Who, not how. Okay, so we're here, Multifamily Mentors. We got Gino in the studio. We just met 6 days ago, and he's here in Denver. It's amazing. And we're talking about his background in hospitality, transitioning to multifamily, and the ways that he's built his business, the thoughts that he's had, all these amazing things that he's done. So one of the things I really admire about you when I first heard you on BiggerPockets maybe 3 or 4 years ago was, your how you started with a mentor, and now how you're providing a lot of mentorship. So episode 2, we're going to go back to my office. We're going to interview you and your wife, and we're going to talk about mentorship, which you know a lot about, right? So talk about some of the mentors you've had and how it's played a role in your business and where you're at today.
2008, Rich Dad Poor Dad, first coach, real estate coach.
Robert Kiyosaki.
$5,000 coaching.
You hired their coaches?
I hired the coach. They had a coaching program back in 2008, and I thought $5,000 was a ton of money. I was like, $5,000?
It's a lot of pies.
Woo! That's exactly. That's how I was like, man, how many pies is that? I was looking at it as an expense, not an investment, right? That's exactly.
How many more pies do I have to sell to pay for this coach?
500 pies, 10 bucks a pie. That's a lot of
pizzas.
That's like 2 weeks, 2 weeks worth of pizzas, dude. And in the next one, I'll say Dave Lindahl. I love Dave Lindahl's program back in 2008. 25 G's. That's a lot of pizza pies you're talking about. Got to throw some chicken parms in there as well. So it was a ton of money. But now that I look back, like I said, it was an investment in myself, not an expense. That's the first thing that we all think of when we're first starting out on our journeys. And Terrence, it led me to become a life coach. I actually went to become a life coach because I wanted the personal development. And I love life coaching. I think it's an amazing endeavor. I think everyone should get it. You get clarity on it. Continuing up with scaling up. Continuing up with traction, because when you're scaling businesses, who's ever scaled a business? You don't come out of the womb saying, hey, I got all the skills to scale a business, right? Nobody does. You don't know that kind of stuff.
I'm an innovator.
We create multifamily entrepreneurs at Jake and Gino. So for us, you're creating a business. So when you're first buying your first and second and third deal, you're not thinking about it as a business. You're thinking about it as being a landlord. You're not looking about it as having an asset and building a business. You've got to shed the I'm a mentality. I'm going to do this. I'm going to do that. I'm going to do everything. IMA gets burned out real quick. So when you hit 60 or 70 units, IMA better hire a property manager, and you better start scaling and start getting a maintenance tech. And then all of a sudden things start falling into place. And if you look at it as an entrepreneurial journey, you'll be like, I need help. Like I said, who, not how. Who can I hire next? Who can I help out? And that's what happens when most people fail. They don't look out and they don't look at it as an entrepreneurial venture. They don't look to continue to grow. What is the saying? Your income can only grow to the extent that you grow. If you're not growing and you're not investing in yourself, you're going to be stagnant. That's why I only had one restaurant. Never went to do life coaching. Never went to do any kind of personal development. I knew what I knew and I didn't grow.
And one of the things that stuck out to me from our time in Tampa was, you really challenged me on, you had a coach early on to teach you about multifamily. Then you had a coach about business and growth. You even have an opera coach, and I understand now, which maybe we'll get that in episode 2, hopefully. And you have a coach on speaking, right? Because you're a big public speaker, you do a lot of speaking. And so I love that, because I grew up in sports, right? Having a coach in sports, it's like everyone knows that, but no one thinks about it in business and in multifamily or in anything you want to excel at. You got to have someone that's going to push you, challenge you, and guide you through that process. So the last question, as we wrap up here, we ask is, and the audience is going to love this, is tell us about your superpower. What separates you?
She's sitting about 15 feet away from me. She's the mother of my children, 6 kids. We homeschool. So, I mean, she does it all.
Right.
And I don't have to worry about it. The best thing for me, the reason why I've been able to grow is when I go to work, I'm able to focus. I'm able to concentrate. I know the kids are taken care of. I can focus on my job, and she does an amazing job. She's an amazing partner. I love working with her. We've got a podcast together. We've written a couple of books together. She's written the children's book. And for me, I couldn't imagine a life without working without my spouse. I love working with my spouse. I love having my family in the business, whether it was at the restaurant, the kids would work with me at the restaurant. She would come in and work at the restaurant as well. And as we've grown, we've gotten closer. Do we fight? Absolutely. I'm a difficult person to live with. I have like an idea every other 30 seconds. So she's got to pull me back, but I love it. And, one of my goals is to just promote family life. I think having kids is wonderful. I think working with your spouse is wonderful. I think that's, if you want to call it a superpower, I guess the other superpower is just working really hard, being relentless. Say what you're going to do and do what you're going to say. If you do that and you work hard and you get some clarity, anybody can succeed.
And I want to go back because you were, as you're talking about superpower, like you talked about how when you go to work, you're not worried about the home front. That's the beautiful partnership where you have your strengths, she has her strengths, and that's it right there. If you're doing that thing and your partner, whether it's family, business, whatever, you worry about what you're doing, he or she does that. Great partnership there.
Great shout out to Julia. Anything else you want to share with the audience before we wrap up episode number 1? It's been an honor. It's been a real privilege to come out here and spend some time. I love it. I'm glad we came out. Multifamily is a team sport. Get out to the networking events. Get out of your comfort zone and continue to grow, guys.
That is great advice. Viewers, make sure you do us a favor. Like the video, leave a comment. We'll respond. And we will see you in episode 2. We're doing a deep dive into mentors and superpowers. See you then. You're listening to the Multifamily Mentor Show.
Join the conversation.